Okay, option traders, you know that we love selling put options. And me personally, I love selling put options as well. I've been doing it for over 30 years, and I still think it's the greatest option trading strategy of all time. In this video, though, because I get lots of email questions from people saying, Lee, I have a smaller account. Can I still sell put options on stocks if I only have, and in this case, we're going to look at using $5,000 or less as your account balance. So the answer is yes, you can absolutely sell put options with a smaller account, $5,000. I never want to tell anybody what's considered a small account. But in this video, we're going to go over put selling opportunities for small accounts of $5,000. All right, so sit back and let's just jump right into it. All right, everyone, Lee Lowell here from smartoptionseller.com. So we love selling put options, and we'll talk about what selling put options is and how you can use it if you have a smaller account, specifically $5,000. Now, let's do a little history here of what selling put options is all about and why I think it's such a great strategy and why that's really the only strategy that we concentrate on here at the Smart Option Seller. Number one, if you want to have long-term wealth trajectory to the upside over the long run, you have to have some kind of stake in the stock market. And that's typically being long the stock market. It could be long individual stocks or long indexes. But in order to have wealth that grows for the long term, you need to have a stake in stocks. Okay, you need to have some kind of hold on stocks or the indexes. And one of the best ways to have an opportunity to get a stake in a stock is by selling put options. And for those of you that don't know, there's only two kinds of options. There's call options and put options. And in this case, we're only talking about put options. In this case, we're only talking about selling put options, not buying, but selling put options, which is what you are allowed to do in the financial markets. When you sell a put option, you do not have to own that put option prior. You can just sell it out of thin air, and that will be your initial transaction. So what happens when you sell a put option on a stock? Basically, what you're doing is you're entering into an agreement and you're obligating yourself to potentially buy a stock of your choosing at a price of your choosing sometime in the future. So the greatest thing about selling put options is that you get to pick whatever stock you have an interest in, and if you want to buy that stock somewhere down the road, you can pick the price that you're willing to buy that stock. Okay. So the first and foremost thing is that you need to pick a stock that you have an interest in. It doesn't matter what it is, as long as you have an interest in that stock and you know it's a quality stock. You don't want to concentrate on stocks that you've heard from a chat room, from your cousin's, sister's, boyfriend's, ex-wife kind of thing. You need to do your own research and figure out which stock it is that you want to potentially buy. And you have to figure out what price that you're willing to buy that stock. Now, most people, when they buy stocks, they just buy right at the market, which means they buy the stock right at its current prevailing price. The great thing about selling put options is you don't have to commit yourself to buying that stock at its current price. You can choose a price of that stock well below where it's currently trading. And I'm going to show you how to do that in this video. Now, even if you only have $5,000, it doesn't mean that that's going to be your ultimate risk. You can sell put options at strike prices, and strike price is that level of the stock price that you'll be willing to buy at some time in the future. That's called the strike price. So you have the current stock price and you have the strike price is where you eventually want to try to buy that stock. Okay. And even if the stock is, I'm going to show you how you can look at stocks that are over $100 a share and still potentially buy those stocks at $50 and under. Now we talk about $50 strike prices are level here, because if you're obligated to buy stock at $50, it's always 100 shares. The minimum amount of option contracts you can sell is one option contract, which consists of 100 shares of stock. So if you sell a put option with a strike price of 50, that means you're obligating or committing yourself to buy 100 shares of that stock at $50 a share, which would be a $5,000 outlay of cash. So we're gonna stick with strike prices $50 and under in this video, but it doesn't mean that we have to use stocks that are currently $50 and under. All right, we're going to go over that. So as long as everybody understands that in order to sell put options, you sell that put option at the strike price of your choosing for the expiration of your choosing, and it's a stock that you want to have, and you're going to get money right up front for that obligation. It's the greatest thing ever. You're choosing to buy a stock at the price you want, and someone will pay you for your obligation. And when you sell that option contract, you get that money right up front into your account. And that's how selling put options work. So let's go start taking a look at some cheaper stocks, quality stocks that would be good for you with a smaller account to sell put options on. So what you see in front of you here is a chart. This is a chart of a daily chart of AT&T. Okay, here's the symbol up here. Top hand left, you can see. So AT&T's had a nice run higher since last summer, July of, this is actually July of 2023. So this has been a nice 2-year run higher. And you can see AT&T's current stock price is $27.42. That's where it closed Friday, May 23rd, 2025. So if you are gung-ho on potentially buying shares of AT&T, not only can you just buy the shares of the stock itself, if you wanted to buy 100 shares of AT&T, it would cost you $2,742. But if you're interested in potentially buying AT&T even cheaper than $27, you can sell a put option at a strike price lower than that. So let's go and take a look at the option chain here and see what we can do with AT&T. All right, so I pull up the option chain here. For those that are not familiar, if you have a brokerage account, most option chains look like this. You got the call options on the left, put options on the right. So we're going to concentrate on this side. And really the only columns that you need to know are the bid and ask prices and the strike price columns. The strike prices, as I said, is the, let me pull up AT&T here. So this is AT&T. So you have your strike prices here. And for a cheaper stock like AT&T, the strike prices are listed at $1 increments. And here's a lot of the different expiration dates. If you click the More tab, you can see expiration goes all the way out to January 15, 2027. So you choose which expiration date, meaning how much time do you want to give for this trade to play out, okay? So 2 things you need to understand. Whatever expiration date you choose, the bottom line is, will AT&T finish above your strike price or below your strike price at the expiration? Now, if AT&T finishes above the strike price, you will not get to buy the shares because AT&T has to be below your strike price at that time. So let's look at an example and we'll go through it and I'll tell you what you need to know. So you're okay with potentially buying shares of AT&T, but even though it's only trading at $27, you want to try to get it for cheaper. So what do? Now, you go through the expiration dates, and we're just going to pick a hypothetical expiration date here of October 2025, 146 days from now, and we're going to scan down the strike prices here and see how much money you will receive for your obligation to buy shares of AT&T. So going back to the chart, what you can do is you can look back to the past and say, what would be a good level for me to potentially buy shares of AT&T? It's trading at 27.42, and then 2 years ago it was trading around 14. So maybe somewhere in between 14 and 27. It's a $13.50 range or so. So maybe 50% down the middle. So let's just say somewhere between, how about 21, somewhere between $20 and $21. You can scroll back here and you can see $21 was actually that last line of support, 1, 2, 3. So it really had bounced off $21 3 times before it started going higher. So let's just say you say to yourself, what? I want to buy shares of AT&T, but I don't want to pay more than $21 for it. Now you can't buy it for $21 because right now it's trading for $27.42 in the open market, but you can sell a 21 strike put option contract that'll obligate you sometime in the future to buy shares of AT&T for $21 a share. And for that obligation, you will receive money up front. So let's go back to the option chain here. And we can look at, we just got October pulled up. So the 21 strike right here, look at 21, and then you scan over to the bid and ask column. So this thing closed on Friday, May 23rd, between 29-cent bid, 32-cent offer. We always want to do something in the middle. So let's just say we can sell this thing for 30 cents per contract, which has 100 shares in it. So you would receive 30 actual dollars in your account right up front for selling this one put option contract. One contract obligates you to buy 100 shares of stock, and in exchange for that, you will receive $30 in your pocket right up front. Now, once you sell that, you get the money, the 30 bucks. Now you're on the hook until October, and the bottom line is, will AT&T finish above 21 or below 21 at the expiration date? So 2 things there's two possibilities. If AT&T finishes above $21 a share at expiration in October, you will not get to buy your shares at $21 because no one's going to sell them to you at $21 if in the current market it's trading above that. But your consolation prize in this case is that you get to keep the $30 that you received from the day that you initiated a trade. Now, if AT&T finishes below $21 at expiration, you not only do you get to keep the $30, but now you have to fulfill your obligation and buy 100 shares at $21 a share and pay your $2,100. Buy 100 shares at $21, and you have to pay your $2,100 debit at that point in time. Okay, so depends where AT&T is at that point. If AT&T is at $19 and you have to buy it at $21, you still have to fulfill that obligation. But you have to remember, 5 months ago, before you did this trade, AT&T was trading at $27, and you said, okay, I'd be willing to buy AT&T at $21 while it's currently at $27. So you're making a decision today for 5 months in the future where you'd still be willing to buy the shares of stock. Now, you can get out of the trade at any time you want. If AT&T starts falling and dropping and you're like, you know what, I don't think I want to buy it at $21 anymore, then all you have to do is go back into the market and purchase this same put option back at for whatever price it's trading for at that time. Now, when you buy it back, you may have to buy it back for a higher price than what you originally sold it for. That would lock in a loss. Or if this option price is trading cheaper than 30 cents per contract, let's say you can buy it back for 25 cents a contract, you make yourself $5 in profit and you're out of the trade. So you can get out at any time. All right, so let me show you how you do this, how to invoke the actual trade. So if you want to sell this $21 put option contract, you click on the bid, and it's probably the same with most brokers. That invokes the trade line here. So let's just say we're going to sell this thing for 30 cents a contract. So we're putting in an order to sell one contract quantity at a price of 30 cents per contract. And in this case, the broker, when you hit click transmit, it's going to show you what the thing looks like before you actually send and execute the order. It's telling you you're going to sell one October 21 put for AT&T, and you're going to get $30 for it. And here's your estimated commission. Now, when you sell put options, when you sell any options, whether that's calls or puts, there's two types of accounts you can have. You can either have a margin account or what's called a cash secured account. When you have a margin account, if you signed up and you're approved for a margin account from your broker, the broker does not make you put up the full $2,100 ahead of time in order to make this trade. Okay, so what I'm saying here is that eventually you might have to pay $2,100 to buy your 100 shares, but the broker is not going to make you put up that $2,100 right away. They're going to let you do this in what's called a margin account, and you'll have a margin requirement. And a margin requirement is a fraction of that $2,100 that you need to keep on hold aside while the trade plays out. Typically, it's not more than 20% of that $2,100. Now, if you look at right over here, let me show you what it looks like. In this is a fake simulated account, and most brokers have what they're called paper trading accounts. So you can practice all you want without real money. So before you're going to execute this trade, you can see there's no margin requirement over here. It says initial margin, and then there's what's called maintenance margin. So the initial margin is $0. If you were to execute this trade and the trade went through, you would have a margin requirement of $372. That would be on hold. You have your $5,000 balance. Now you're using $372 of that $5,000 balance that's held aside. Can't use that anymore. So you have $4,628 left to play with. All right. Now, the $372, let's see what percentage that is, that margin requirement. If you don't have to put up the $2,100 full dollars, 372, let me get my calculator here, 372 divided by 2,100, that's about a 17.7% margin requirement. So out of that $2,100, this broker is only going to ask you to keep aside 17.7% of that $2,100. And that's your $372 right here. Now, the maintenance margin is $312. this initial number 372 can fluctuate higher or lower over the course of the trade, but the minimum amount you have to hold aside at all times, no matter where the stock is what's called this maintenance margin. It's a little bit less, $60 less, okay? So that's how you would actually sell a put option. Number one, choose the stock, choose the strike price that you're willing to potentially buy the shares of that stock, sell the put option, collect the cash, and know what your margin requirement is. Now, I talked about cash secured accounts as well. That's the second type of account, cash secured. If you have a cash secured account, that means your broker is going to make you put aside on hold the full $2,100 at all times. Whether you end up buying the stock or not, you still have to hold aside $2,100. For me, that's not using your money very efficiently. I like to use a margin account because the way that I sell put options, the stock has a very little chance of falling that far. So I don't want to put up the full amount of money if there's really a small chance of me ever having to buy the shares of stock. But it depends on what kind of account that you have at your broker. All right, so that's pretty much it. That's pretty easy how you do it, smaller account. Now, there's many different stocks out there that you can choose that are trading under $50 for strike price. Now, we can look at a couple different stocks here, and I'll show you some that are even closer to $50, $60 you can sell put options on. Let's just go through my list here, see if there's other stocks. Like, let's look at Bristol Myers, okay, BMY. It's trading for $46.85. So the other thing to mention is that you sort of want to have a stock that's more or less in an uptrend, because you know that stock more than likely will keep going up in that uptrend. If you have a stock that's just going down, 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 you know, trying to pick a bottom is probably not the best thing, but even though the stock is cheap, it can always get cheaper. So something like Bristol Myers has been trading in a wide range for, you know, at least 10 years or more now, between $40 and $80. So we can look at the option chain and see if there's anything good on Bristol Myers. Okay, I don't have it pulled up here, but let's create a new tab here, BMY, and see what we can see how it's looking. Now, you can choose any expiration you want. The longer you go out in time, the more money you will receive when you sell that put option, but it just means you're giving the stock more opportunity to potentially drop in price. Now, that depends on what you want. Now, just because you can sell put options and get the cash doesn't mean that you should just start selling put options on any and all stocks just because you can get this cash. You want to make sure that it's still a stock that you like, a quality stock that you would be willing to buy if it fell down to your strike price. A lot of people start selling put options on stocks that they know nothing about. And before they know it, stock craps out. They're ending up buying all these shares of stock, the stock they don't really want. So make sure it's a stock that you want. So on Bristol Myers, if we go out to October, they don't have October. So let's look at September. Stock's trading around $46. You choose the level that you potentially want to buy the stock for, and we can go down to stocks trading at $46.90. You can go all the way down to the $35 strike price and get, you know, close to 50, you know, high 40s, close to 50 cents per contract. That's almost $50 in your pocket at a $35 level. That's about almost $12 below where BMY is now. $35 would be down here. So here's that, you know, last line of support. It didn't trade below 35 much after 2013. So maybe you're thinking to yourself, Bristol Myers would be a good stock for me to buy at $35 a share. Totally up to you. Okay. So let's look at some others. Let's go to the option chain and see what other stocks we have here. So let me pull up Palantir. Before I show you the option prices, let's look at Palantir stock. Now, Palantir is a great stock. It's got so much bullish momentum. Great stock to sell put options on. In our newsletters, both of our newsletters, we're actually selling put options and put option credit spreads on Palantir. Great stock. Now, Palantir is trading around $123 a share. Let me show you what kind of strike prices you can sell these put options. If you're bullish on Palantir, but you do not want to buy shares at its current price of $123, let me show you what kind of put options there are. Now, just remember, everybody, these are not real recommendations. These are not live recommendations. These are just examples of things that I'm showing you could potentially look at. So Palantir, let's go out to October and let's see if we can get one under $50. Okay, if your account balance is $5,000, you know you can sell at least a $50 strike price. Let's see what we got. Let these prices load up here. So for October, for Palantir, 50 strike price. Okay, now the market's closed as I make these videos on the weekend. So these prices, the bid and ask, are pretty wide. Okay, during the day, these things would be, the bid ask would be maybe 5 cents apart, if that much. Let's look up to see if there's anything a little bit tighter in the bid ask spread. Now, we don't always want to typically look at the last price because the last price could have happened a while ago. You always want to look at the bid-ask market for the current up-to-date pricing. All right, so let's look at September here. 118 days from now, the 50 strike price, 52-cent bid at 85-cent offer. The last trade was 55. I know I just said not to concentrate on that, but Palantir is a very widely traded stock. Lots of volume. So let's just pretend that you can do this somewhere in the middle. Let's just say you can sell this thing for, I don't know, 65 cents a contract. Okay, 65 cents a contract would get you $65 right in your account. And now you're obligating yourself to buy Palantir for $50 a share. It's trading at 123 right now. Someone's going to pay you money to buy Palantir for $50 a share in the next 118 days. That's just incredible. Let's look at the stock chart again. $50 is all the way down here. Current price up here, $50 all the way down here. If you're willing to step up and potentially buy 100 shares of Palantir for $50 a share, someone will give you over $50 in your pocket today. Is that enough money for you? Is that a good trade for you to do? It's like someone's paying you to come buy a stock really cheap. Now, you might think about what kind of returns can I get on a trade like this? So this is Palantir, so September. And if you have a margin account, the 50 strike, your broker would only require you to put up about $1,000. Okay, not if it's cash secured, you got to put on hold $5,000. Let's see what it would say. Let's invoke the trade, click on the bid, and we're going to put in a price of, let's do 60 cents. When we click on transmit, it brings up the box. All right, so the initial margin requirement is $1,180 on the 50 strike price. So that's a little over 20%. It's probably like 21% is the margin requirement in this case. Palantir is a very active stock. Broker probably wants to have a little bit more cushion for themselves, so they bump up the margin requirement a little bit. So if you have a margin account, all you have to do is put up $1,180. But you know, ultimately, if you have to buy the shares, you will have to come up with that $5,000 at expiration. All right. Now you can even look lower in strike if you're like, I want to buy Palantir for $40 a share potentially. And let's see what the price there. So you can get probably, I don't know, 35 cents a contract, which is 35 actual dollars. And let's see what the margin requirement would be on here. And let's say we're going to sell this thing for 35 cents. Check the margin. Okay, so the margin is only $628. Here's how you figure out your return on that trade. If this trade was to go to expiration and Palantir didn't fall down to $40, you keep that 35 bucks. And $35 on a $628 hold, that would give you a return of 5.5% return on the margin. 5.5% on 118 days. So if you wanted to annualize this thing, let's do 365 divided by 118. That's 3.09 times 5.5. So roughly a 17% return on margin annualized. It's a pretty good deal. Pretty good deal. All right. Now, lastly, let's look at Tesla here because Tesla just has some crazy options, some crazy prices. Tesla's at $339 and change as it closed Friday, May 23rd. If you go out to December on Tesla, you can go all the way down to even right here, the 50 strike price on Tesla, 24-cent bid at 49-cent offer. During market hours, that market would be a lot tighter. This bid-ask market quote would be a lot tighter. Let's just think you can do this thing for 35 cents. Tesla's at $339. You're obligating yourself to buy for 50 bucks. Pretty good deal, okay? Same thing, broker, let's see how much they would have for the margin requirement. Let's think we can sell this thing for 35. No, let's do 40 cents just for, and the margin requirement is only 546 bucks. 546 bucks, and you can get 35. Let's do, if we collected 40 bucks divided by, what was it, $356. So that's like 11% return for 209 days. Not too bad. All right. So that's how you do it. That's how you sell the put options with a smaller account, $5,000 or less. If you're wondering, where do I find the stocks like this? How do I find stocks that are, cheaper, under $50 or even higher? As you can see, Tesla, you can sell 50 strike put option. You can always go to, let me show you a couple places here where you can, check quality stocks. You can go to CNBC. Here's the Dow 30 component. So there's only 30 stocks in the Dow, and you can pull up this component here, and you can filter it by price. So Verizon, $43, Nike, $60. Check the option chain, okay? You can also go to barchart.com. Here's the S&P 500 components, 500 stocks. Go through the list. I've already sorted them by price. Look at some Ford, Walgreens. Then you look at the names, go to the charts, see how the stock's been trending. If you want to cross compare, you can go to something like, this is the Dividend Champions list, which shows you these are quality dividend paying companies that have raised their dividend 25 years in a row or more. Okay. You can get this from, where's the website here? Let me show you what website you can get this. dripinvesting.org. Okay. I'll put a link in the description below. When you put in your email address here to download the Dividend Champions list, this is what you will get. This is in a Google Doc, and it tells you how many years the company's been raising their dividends. Companies that have raised their dividends for years on end are a quality company. So go through the list and see, and you can filter it by price here as well for those under $50 or around that price. And if you see some that then you can start looking at selling put options on those. All right. So that's about it. That's how you sell put options with a smaller account. Still, number one, make sure it's a stock that and a stock that you want to buy. Okay. Don't go for these high flyers that you know nothing about, and figure out what are the chances. What are the chances of Tesla going from $340 all the way down to $50? It's probably not going to happen. It's a very small percentage. But if you're okay potentially buying Tesla for $50, you can do the trade. All right, that's it for me. I hope this has been helpful. Make these videos free for the trading community. We all want to help each other out. Don't forget to subscribe. Hit that subscribe button in the bottom right-hand corner. Tell your friends, tell your spouse, tell your cousins, tell your colleagues. Join our channel. Let's make these things go viral. Give me a thumbs up. Leave me a comment. Send me an email. Let me see. Let's go to our website real quick, smartoptionseller.com. Hang on for a second here. All right, we're at smartoptionseller.com. If you know nothing about selling put options, you want to learn more about it, go to our website, click on the free ebook right here, Put Selling Basics. It's all about selling put options, why we love it so much, why it's such a great strategy. Put your name and email address here, and we will send you an email back with a link for the free ebook. If you want to go a little bit deeper, we have our video series. If you want to learn about another trading strategy that we've been talking about, you can look at my Warren Buffett ebook, and here's our services right here. We have a couple newsletters, we have our one-on-one coaching, and we have our probability calculator that can help you figure out what are the chances of a stock going from point A to point B in X amount of time. It's a great little tool. All right, that's it for me today. Remember, read down in the description below. Please read down the description below the video. I've got books and websites and other software and things that'll help you out in your option trading game. All right, that's all for me today. This is Lee Lowell. I'll see everyone in the next one.